Picture this. You are sitting at your kitchen table in the fall of 2008, and the letter in your hand is from your bank. Your mortgage payment, the one that used to be manageable, has just jumped by $400 a month. You didn't lose your job. You didn't make a reckless purchase. You did everything you were told to do. And yet the number on that page feels like it belongs to someone else's life. This is the story of how an entire generation learned, the hard way, what money actually is. Not what it represents on a bank statement, but what happens when the systems we trust to hold our money quietly stop working the way we assumed they would. To understand 2008, you have to understand a word that most people had never heard before that year: the subprime mortgage. A subprime mortgage is a home loan given to a borrower with a weaker credit history, someone who, under normal lending standards, would be considered a higher risk of not repaying the loan. In the years leading up to the crisis, banks handed these loans out at a staggering pace, often with adjustable-rate mortgages attached, meaning the interest rate started low and then reset higher after a fixed period, sometimes doubling a homeowner's monthly payment overnight. Consider Marcus, a composite example representing millions of families who lived through this exact pattern. Marcus and his wife bought their first home in 2005. Their loan officer told them not to worry about the rate resetting in 3 years, because home values only go up. That single sentence, repeated in living rooms across the country, was the quiet engine of the entire crisis. Marcus believed it because everyone around him believed it. His neighbors were refinancing to buy boats and renovate kitchens, treating their homes like ATMs instead of shelter. It felt less like a financial decision and more like the only sensible thing anyone could do. Here is where the story becomes less about one family and more about the entire architecture of the financial system. Banks did not simply hold on to these risky mortgages. They bundled thousands of them together into financial products called mortgage-backed securities, which are essentially investment bundles made up of many individual home loans, sold to investors who receive payments as homeowners pay their mortgages. In theory, this was supposed to spread risk out so that no single institution was overly exposed. In practice, it did something far more dangerous. It obscured risk so thoroughly that even the institutions selling these products often did not understand what they contained. The economist Robert Shiller had actually warned about this years earlier. In his book Irrational Exuberance, Shiller argued that housing crises were behaving less like a reflection of real value and more like a speculative bubble, driven by psychology rather than fundamentals. Almost no one in the mainstream financial world wanted to hear it. Home prices had been rising for so long that the idea of a nationwide decline seemed almost impossible. That belief, that housing could not fail everywhere at once, became one of the most expensive assumptions in modern economic history. By 2007, cracks were already showing. Homeowners like Marcus began missing payments as their adjustable rates reset. Foreclosures rose. And because so many of those mortgages had been bundled into securities held by banks, pension funds, and investment firms around the world, the pain did not stay contained to individual households. It spread into the veins of the entire financial system. In September 2008, Lehman Brothers, one of the largest investment banks in the United States, collapsed. Credit markets froze almost overnight. Banks became afraid to lend to each other, let alone to ordinary consumers, because no one knew who was secretly holding worthless mortgage bundles. The Financial Crisis Inquiry Commission, a bipartisan body created by Congress to investigate the causes of the collapse, later concluded in its official report that the crisis was avoidable, the result of human action and inaction rather than an unpredictable natural disaster. That distinction matters. This was not a hurricane. It was a slow accumulation of decisions, made by regulators, lenders, rating agencies, and everyday borrowers, all operating on the same flawed assumption that the good times would simply continue. For Marcus, the turning point came the week his adjustable rate reset. His mortgage payment jumped by over 30% in a single month. He and his wife were not reckless people. They had steady jobs and a modest savings account. But they had no emergency fund, meaning they had no separate pool of money set aside specifically to cover unexpected expenses without going into debt. When the new payment hit, they had nothing to absorb the shock. They started paying the mortgage with credit cards. Within a year, they owed more on interest payments than they had ever imagined possible. This is the moment where the psychology of a crisis becomes just as important as the mechanics of it. The behavioral economist Richard Thaler has spent much of his career studying why people make financial decisions that contradict their own long-term interests, work that eventually earned him a Nobel Memorial Prize in Economic Sciences. Thaler's research on present bias helps explain why so many families during this era prioritized short-term relief, like using credit to cover a mortgage gap, over long-term stability. It is not that people are foolish. It is that human brains are wired to weigh immediate pain more heavily than distant consequences, especially under stress. Marcus was not thinking about what his debt would look like in 5 years. He was thinking about how to keep his family in their home next month. The struggle deepened for millions of households throughout 2008 and 2009. Unemployment climbed as businesses cut costs in response to the credit freeze. Retirement accounts, many of them invested in the stock market, lost significant value almost overnight, teaching an entire generation a lesson about market volatility that no textbook had managed to convey. People who thought they were 5 years from retirement suddenly found themselves a decade behind. Trust, which is really the invisible currency that holds any financial system together, had been badly damaged. People stopped trusting banks. They stopped trusting the idea that hard work and responsible behavior were enough to guarantee financial safety. But this is also where the shift begins, both for families like Marcus's and for the culture at large. Slowly, out of necessity, something changed. Families began building emergency funds, not as an abstract piece of advice, but as a lesson paid for in real suffering. The idea of living below your means, once considered old-fashioned, became newly relevant. Financial author Suze Orman, whose books on personal finance became especially popular in the years following the crisis, repeatedly emphasized the importance of having accessible cash reserves before taking on any new debt, a message that landed very differently with an audience that had just watched their financial safety nets disappear. Marcus and his wife spent nearly 6 years digging out of the debt they accumulated during those months. Their strategy was not glamorous. They renegotiated with their lender for a fixed-rate mortgage, meaning an interest rate that stays the same for the life of the loan rather than adjusting over time. They cut expenses aggressively, sold a car they could not afford, and slowly rebuilt a small emergency fund, 3 months of expenses at first, then 6. There was no single dramatic turning point, no windfall or lucky break. It was a long, unremarkable process of rebuilding trust in their own financial decisions, one small consistent choice at a time. The broader result of 2008 reshaped financial regulation and financial behavior for years afterward. The Dodd-Frank Wall Street Reform and Consumer Protection Act was passed in 2010, introducing new oversight of the financial industry designed to prevent the kind of hidden, systemic risk that had gone unnoticed for so long. On a personal level, national savings rates rose in the years following the crisis, as households that had once treated their homes as sources of instant cash instead began prioritizing liquid savings and more conservative debt levels. For Marcus, the lasting change was not really about spreadsheets or interest rates. It was about a fundamental shift in how he understood risk. He stopped assuming that any single financial product or any single institution was too reliable to question. He began asking what would happen if the worst-case scenario actually happened, rather than assuming it never would. That single mental shift, treating financial stability as something you build deliberately rather than something the system guarantees for you, is arguably the most valuable inheritance the crisis left behind. So what can you actually take from this today? The first lesson is about emergency funds. An emergency fund is not a luxury for people who already have extra money. It is the single most effective buffer between an unexpected event and a spiral of high-interest debt. Even a modest cushion, built slowly, changes how a family experiences a financial shock. The second lesson is about understanding exactly what you are signing when you take on debt, especially variable rate debt. Ask what happens if the rate goes up, not just what the payment looks like today. The third lesson is more psychological than practical. Be suspicious of any financial assumption that everyone around you seems to accept without question, whether that is the idea that home prices always rise, that a certain investment cannot lose value, or that a lender's reassurance is a substitute for reading the fine print yourself. None of this is meant to suggest that individual choices alone caused or could have prevented a crisis of this scale. The Financial Crisis Inquiry Commission was clear that failures in regulation and risk assessment at the institutional level played a defining role. But within that larger story, the households that recovered fastest were often the ones who had, even unconsciously, built in some margin for error before the crisis hit, and the households that struggled longest were disproportionately those operating with no buffer at all. This video is intended for educational purposes and reflects general historical and economic information rather than personalized financial advice. Everyone's financial situation is different, and decisions about debt, savings, and investing are worth discussing with a qualified professional who knows your specific circumstances. The 2008 crisis did not just cost people their homes or their savings. It cost an entire culture its assumption that the system would always catch you. What it left behind, for those willing to learn from it, was something more durable than any single investment: the understanding that financial security is not something you inherit from a stable-looking system. It is something you build, deliberately, one buffer at a time.